Welcome to the Deep Dive. We're here to unpack the earnings calls that really matter, getting you the insights you need. Today, we're tackling Jones Lang LaSalle, JLL, their Q2 2025 call. They're a huge global player in real estate services, and, well, the market's definitely complex right now.
Absolutely. Constantly evolving.
Exactly. So our goal here is to pull out the key takeaways, understand your strategy, and figure out what it all means for JLL and, the wider real estate picture you might be invested in or watching. So maybe let's kick things off with the top line numbers. JLL put up some pretty solid results for Q2.
They did, yeah. Pretty strong showing.
Non-GAAP adjusted EPS came in at $3.30. Now, that adjusted bit, just to clarify for everyone, usually means they've stripped out some unusual or one-off items to give a clearer view of the core business performance.
Right, the underlying operational profit.
And that $3.30 beat the consensus estimate of $3.20. So up about 3%. Not bad. Revenue also looked good, $6.25 billion. That was just a hair above the $6.23 billion analysts expected.
And what's really worth noting there, I think, is the trend. That's the fifth quarter in a row they've posted double-digit revenue gains.
5 straight quarters? That's quite a run.
It really is.
Yeah.
And digging a bit deeper, adjusted EBITDA, earnings before interest, taxes, depreciation, amortization, that key operational profit measure that was up a healthy 18% compared to last year, hit $291.7 million.
Okay, 18% year over year on EBITDA.
Yeah. And free cash flow, so the actual cash generated after reinvesting in the business, that jumped 22% year over year, came in at $288.4 million.
Wow, strong cash flow growth too.
Definitely. Now, interestingly, the stock dipped a bit in pre-market trading right after the release.
Oh, really? Why do you think that was? Initial reaction, maybe?
Could be. Sometimes the market needs a moment to digest. But it recovered during the trading day, actually closed up about 0.8%, and on much higher trading volume than usual.
Ah, okay. So higher volume suggests more conviction. Investors ultimately liked what they saw after digging in.
Seems that way, yes. The market ultimately processed it positively.
Okay, that's the financial picture. Now let's really dive into the strategy. JLL talks a lot about this two-engine model. Sounds like it's really working for them, giving them a solid base.
It really does seem to be the core of their resilience, yeah.
How does that diversification actually play out in such a, choppy market like global real estate?
Yeah.
Is it just playing defense, or is it actually letting them be more aggressive somewhere else?
That's a great question. It's not just defensive. So this two-engine model basically splits the business, right? You've got the stable, fee-based, resilient services, and then the more cyclical transactional stuff like brokerage and capital markets.
Right.
In Q2, those resilient lines were definitely the growth engine. Their real estate management services, or MS, revenue was up 11% in local currency.
Okay, 11% growth there.
And that part of the business, managing properties, handling projects for clients, it's just less exposed to interest rate swings or deal flow drying up suddenly.
So it smooths things out, gives them a predictable income.
Exactly. Predictable revenue, which investors love, obviously. But it also, and this is key, it gives them the stability and the cash flow to be maybe a bit more opportunistic on the transactional side when things do slow down. It's stability enabling agility, as you put it.
Stability enabling agility. I like that. Okay, so within those resilient services, what really stood out? I noticed project management had a huge number.
Oh, absolutely. That was a big takeaway this quarter. Project management revenue surged 22%.
22%. Wow.
Yeah, it's a significant number. And they said it was down to their global unification efforts really paying off, plus just strong demand for mid-sized projects.
So companies are still spending on projects, just maybe smaller ones, or upgrading existing space?
Seems like it. It suggests companies are maybe prioritizing, optimizing the assets they already have rather than big new builds. Could be construction costs, could be uncertainty, probably a mix.
Makes sense.
And workplace management was also strong, revenue up around 10% there too. So yeah, the strength and the scalability of these fee businesses, it really validates their strategy, gives them that solid foundation.
Okay, that makes sense for the stable side. But what about the transactional side, the part that's usually more, sensitive to the economy? How's that holding up?
Well, building on that two-engine idea, the transactional businesses, they definitely face those macro headwinds we all know about, but they still grew. Capital markets services revenue was up 12% overall.
12%, even with the headwinds. That's pretty good.
It is. And within that, debt advisory was like the real star. It jumped 27%.
27%. What's driving that?
They pointed to pretty resilient debt markets, surprisingly, and a lot of refinancing activity, especially in the U.S. and also in Europe's residential sector.
Interesting. So deals are still getting financed.
Seems so, particularly refinancing existing debt. Investment sales were also up, about 9%, and leasing advisory grew 5%. That leasing growth was really pushed by industrial real estate.
Ah, industrial's still hot then.
Very much so. Up 11% globally, and even stronger in U.S. industrial, up 13%.
Now, here's something I found really interesting, maybe a bit counterintuitive. U.S. office leasing revenue was actually up almost 3%. Even though we know overall office market volumes are down. How does that work?
Yeah, isn't that fascinating? It really speaks to JLL maybe capturing market share or being focused on specific segments within office that are doing better.
Right. But you also mentioned something earlier that management did need some delays, decisions taking longer.
Yes, exactly. They flagged an uptick in delayed and sort of prolonged decision-making,
Okay.
especially hitting larger capital projects and bigger investments.
Okay.
And they put that down mostly to the uncertainty we're seeing everywhere, geopolitical tensions, trade issues, questions about fiscal policy. They even said some big capital market deals got put on pause back in early April because of all this, quote, policy noise.
Policy noise, right. Yet management also apparently said clients are, and I think this was the quote, accepting the noise in the world and they just move on and do their business. Isn't there a bit of a tension there? Are they delaying things or moving on?
That's a really sharp observation. It sounds contradictory, but maybe it isn't entirely.
How so?
Well, it seems like there's a split. For those really big discretionary capital markets deals, the billion-dollar decisions, yes, the uncertainty is causing delays. Companies want more clarity before committing that kind of capital.
Okay, makes sense for the huge stuff.
But for the core operational stuff, managing the buildings they already have, doing those necessary mid-size upgrades we talked about, businesses can't just stop. They have to move forward.
Ah, I see. So they're adapting rather than freezing.
Exactly. They're maybe building in more flexibility, more contingency planning, which, interestingly, probably increases demand for JLL's advisory services to help navigate all that complexity. So it's less about paralysis, more about cautious, adaptive action.
That makes a lot of sense. Okay, so growth seems pretty resilient overall. How are they actually funding all this? What's the balance sheet look like? Are they taking on risk to achieve this?
Actually, quite the opposite. Their financial health and their discipline around capital allocation really stood out on the call.
Oh, yeah.
Yeah, the balance sheet looks robust. They have $3.3 billion in liquidity available.
Okay, that's a good cushion.
And their net leverage, basically their debt compared to their earnings, it actually improved. It came down to 1.2 times from 1.7 times a year ago.
1.2 times net leverage, that's pretty low.
Very much so. Well inside their target range, which is 0 to 2 times. So it signals a really conservative, healthy financial position.
And this really raises a key question for you, the listener, the investor. How does this kind of discipline actually create long-term value?
Exactly. Well, first, they're actively returning capital. They bought back $41.4 million of their shares in Q2.
Okay.
And they explicitly said they plan to increase those buybacks in Q3 and Q4.
So signaling confidence and returning cash.
Precisely. Their priorities seem really clear. First, reinvest in the business, organically improve services, boost productivity. Second, return capital to shareholders via those buybacks. And third, they'll look at M&A, but only selective, small, infill deals that add specific capabilities.
Not big splashy acquisitions then.
Doesn't sound like it. They said the bar for acquisitions is very high. So they're not just chasing growth for growth's sake. It's about strategic fit. It's that disciplined, balanced approach. Invest for the future, reward shareholders now, and keep the balance sheet strong.
Okay, let's shift a bit to some of their specific strategic moves. They're investing heavily in data, tech, and AI, right? To improve efficiency and offer more integrated solutions. That seems critical these days.
Absolutely critical. It's clearly central to their long-term plan.
What kind of AI stuff are we talking about? Is it just buzzwords or is it actually changing how they operate?
It seems pretty tangible. They're using AI across the board, trying to optimize property management, improve energy efficiency in buildings, get better at predicting market trends, making their client advice sharper.
So like predictive maintenance or using AI to figure out the best use of office space.
Exactly, those kinds of things. Or even automating parts of lease management. The goal is to offer these really integrated, proactive solutions that make them, well, indispensable to clients dealing with all this complexity.
Indispensable, that's the goal. But it wasn't all smooth sailing in the quarter, was it? There was that issue with Fannie Mae.
Ah, yes. Good point. They did take about a $14 million expense. It was related to an enhanced loss-sharing agreement they have with Fannie Mae, the big U.S. mortgage entity.
Right.
It was tied to a specific portfolio of 3 loans where, unfortunately, borrower fraud was confirmed. So a specific hit, but they flagged it.
Okay, so a known issue they've accounted for. And operationally, they're also reviewing their property management portfolio. What's that about? Sounds like it might cause some disruption, maybe losing contracts.
It might in the short term. They acknowledged it could lead to some elevated contract churn.
So why do it?
Long-term play. It's about realigning for better growth and, crucially, better margins down the road. They're likely looking to maybe shed some less profitable or more complex contracts.
Pruning the portfolio, essentially. Focusing on where they can add more value, probably with that tech integration we just talked about.
Exactly. It's a pretty standard move in mature service businesses. Sometimes you sacrifice a bit of near-term volume to improve the long-term quality and profitability of the business.
Makes sense. And speaking of specific areas, the CEO, Christian Ulbrich, had some interesting comments on the office market, said there's very little new supply coming online.
Yeah, he noted that and said tenants might have to kind of move a little bit down from the absolute top-tier buildings, maybe into Class A- or even older buildings.
So the flight to quality might hit a supply wall for the absolute best space.
Seems to be the implication. But he also highlighted the flip side.
Ah, the opportunity.
Right. The flip side is that owners of those slightly older A- type buildings, they're going to have to invest heavily to upgrade them to make them competitive.
And that plays right into JLL's hands, especially with that strong project management growth we saw.
Precisely. JLL is perfectly positioned to capture that wave of renovation and upgrade spending. So demand isn't vanishing, it's shifting. It's moving towards modernizing the existing stock.
It's almost like a forced revitalization cycle for some of these buildings.
Fascinating. Okay, so given all this, what's the outlook? Did they update their guidance?
They did. They actually raised the low end of their full year 2025 adjusted EBITDA target, bumped it up by $50 million.
Okay, raising the floor. What's the new range?
New range is $1.3 billion to $1.45 billion for the full year adjusted EBITDA.
And how do they see margins progressing?
They expect nonlinear margin expansion, which basically means it won't be a smooth upward line quarter by quarter, but they do expect significantly stronger margin improvement in Q3 and Q4, which kind of fits their usual seasonal pattern.
Okay, so overall sentiment for management.
They termed it constructively bullish.
Constructively bullish.
Yeah.
I like that. Cautiously optimistic, basically. Pretty much. They're pointing to stable fundamentals. They see the case for outsourcing services getting stronger, tenant demand growing, and importantly, those debt markets and capital availability holding up reasonably well.
Okay. Constructively bullish sounds good, but given that policy noise and the pause deals we talked about, what are the potential downsides here? What risks maybe aren't getting highlighted quite as much?
That's always the key question for investors, isn't it? What are we missing?
Right.
Well, while debt markets are resilient now, if interest rates stay persistently high or even creep up further, that could eventually put a damper on that refinancing activity, which would hit their debt advisory growth.
Sure, that makes sense. Refinancing dries up eventually.
And that policy noise, right now it's causing delays. But if global economic conditions really soured, could those delays turn into outright cancellations of major projects? That's a risk, despite what clients are saying today.
Okay, so the macro environment could still bite harder.
It could. And lastly, that AI investment, while definitely strategic and forward-looking, there's always execution risk. How well do they actually implement it? And how fast are competitors moving on the same front? That remains a constant challenge.
Good points. Okay, so pulling it all together, what does this Q2 performance really mean for you if you're tracking JLL or the broader real estate services sector?
Well, I think these results really hammer home how effective that two-engine model is for them. It's delivering pretty sustainable growth, even with all the global disruption going on.
Yeah, the resilience really shows.
And their strong balance sheet, the disciplined capital allocation, the tech investments, it does seem to position them well for whatever comes next.
And it seems the market recognizes that diversification. You mentioned how JLL stock has performed relative to, say, REITs.
Right. That's a fascinating point. JLL has significantly outperformed the IYR, that's the big U.S. REIT ETF, kind of a benchmark for property owners over the last month, 3 months, even the past year.
So investors are preferring the diversified service model over direct property ownership, at least recently.
It certainly looks that way. They seem to be rewarding JLL's execution and broader service offering, maybe seeing it as less volatile than just owning buildings in specific sectors right now.
Interesting. So key things to keep an eye on going forward.
Definitely the timing on those larger capital markets deals closing are the delays easing. Also, watch the impact of that property management review. Does churn pick up significantly? And of course, the ongoing integration and, crucially, the results of their AI and data initiatives. Are they translating into real efficiency gains or new revenue streams?
Got it. Okay, let's switch gears then. Time for our This Is Not Financial Advice segment.
The fun part.
Right. So purely for discussion, based on everything we've just unpacked about JLL, I've got a couple of, let's call them thematic observations, maybe potential angles for our hypothetical investment committee.
Lay them on us.
All right, theme one, the accelerated buyback volatility play. We heard the CFO loud and clear. They will increase share buybacks in Q3 and Q4 beyond that $41 million they did in Q2.
Clear signal.
And they've got the cash, $3.3 billion in liquidity and low leverage at 1.2x. So the intention and the capacity are there.
Right.
The idea here is that this stated intention to ramp up buybacks, especially if they maybe front-loaded a bit in Q3, could inject some real short-term volatility into the stock price.
Okay, so not betting on direction, but on movement itself.
Exactly. A strategy focused purely on capitalizing on potentially sharp, short-term price swings driven by management actively deploying capital to boost the stock. It leans into their stated plan, creating potential choppiness.
Interesting angle, using the buyback itself as a volatility catalyst. Okay, what's number two?
Okay, theme two, the office obsolescence and revitalization dynamic. This builds directly on the CEO's comments.
About the lack of new supply and needing to upgrade older stock.
Precisely. He said very little new product coming to market, tenants maybe having to look at A- or older buildings. But the flip side, as he called it, is this wave of investment needed to upgrade those exact buildings.
Which boosts their project management business.
Bingo. JLL is perfectly positioned there with that 22% growth we saw. So the dynamic creates potential winners and losers. JLL wins from the spending on upgrades.
And the losers.
Well, maybe smaller, highly leveraged office REITs, the companies that actually own the buildings, particularly those stuck with portfolios of just Class B or C assets, maybe in weaker markets, who don't have the capital to do those necessary upgrades.
The have-nots who can't afford the revitalization.
Right. They face the headwinds of vacancies and flight to quality without the resources to compete, while JLL benefits from the upgrade cycle funded by the larger, better capitalized landlords. It's a play on that divergence driven by capital needs.
A pair trade concept, almost long the facilitator, short the potentially obsolete asset owners.
Clever. Just thinking thematically. Okay, that wraps up our deep dive into JLL's Q2 2025 earnings call.
Felt like a pretty comprehensive look. They certainly delivered strong numbers and showed strategic focus in what's still a tricky market.
Yeah, the outlook seemed positive, even with that constructive caution baked in.
That two-engine model really seems to be their anchor, providing resilience. And the capital allocation discipline, plus the tech focus, it positions them quite well, you'd have to say.
It demonstrates that adaptability you need in global real estate right now and shows how vital those forward-looking tech investments are becoming.
Absolutely. It's about building that competitive edge.
So just a reminder to everyone listening, the information we discussed here is purely for informational purposes. It is absolutely not financial advice. Always do your own research, your own due diligence before making any investment decisions.
Couldn't agree more.
Thanks for joining us for this deep dive. We'd love to hear your thoughts. What stood out to you from JLL's strategy and performance in this really dynamic real estate world?